Ladies and gentlemen, as we move into the next panel before our networking lunch, we shift our focus to a dynamic and fast evolving asset class that is increasingly defining portfolio strategies and capital flows, alternative investment funds. This session is aptly titled Alternative Investment Funds, the Future of Diversification in a Changing Market. As India's capital markets mature, AIFs are emerging as strong contenders in the race for innovation, diversification, and value creation. We are starting the session in next 10 seconds. We request all our esteemed dignitaries and delegates to please remain seated and help us begin the next session in time. As we are already behind schedule, so we request your cooperation. Kindly be seated and help us begin the session. And as we can see, our stage is all set. It's all ready. Once again, requesting all our esteemed dignitaries and delegates to please find a seat and please settle down. Ladies and gentlemen, our upcoming panel will deliberate on the challenges and opportunities surrounding AIFs, from regulatory developments and fundraising hurdles to tech disruptions and ESG-led investing strategies. To steer this crucial conversation, we have with us Mr. P.K. Malhotra. Can we all please together welcome Mr. P.K. Malhotra on stage? He is co-chairman, ASSOCHAM, National Council for Corporate Bond Market, and MD and CEO, IDBI Trusteeship Services Limited. A very warm welcome to you, sir. Thank you very much for joining, and I urge you to moderate and give me a minute as I quickly invite our esteemed key speakers, industry leaders. We also have with us Dr. Shikha Bagai, MD, India and Mauritius, Vistara Group. Let's all together welcome Dr. Shikha Bagai. I once again request all our delegates to please be seated. We have started the session, so request all to kindly cooperate. A very warm welcome to you, ma'am. We also welcome Mr. Raghunath T, Head, Credit, Vivriti Asset Management. Can we all please welcome Mr. Raghunath on stage? A very warm welcome to you, sir. And with that, I now hand over the proceedings to our moderator, Mr. P.K. Malhotra.
Hello. Good afternoon, distinguished guests, panelists, industry colleagues, ladies and gentlemen. I know this is the last session before the lunch. I will not try to stretch your patience, but definitely would like to stretch your persistency, your vision, so that you try to diversify your investment into AIFs. AIFs for majority is like an alternate class, and it is for HNIs, niche product, who might be reading offer documents in weekends. And for majority of us, I feel AIF, alternate investment class, is like an, if I want to rename it, it could be like adventurous investment class. We are hesitant to ride it or afraid of not having fun. But actually, as per my thinking, AIF is no more an alternate investment class. If you see the commitments, cumulative commitment which have been made in AIF, it has already crossed around 13.6 lakhs crore. Actual investment has been made, as was told by SEBI chairman, around 5.4 lakhs crore. Already the investment has been made. So gradually, though this AIF are not taking the place of our traditional investments, but they are supplementing those traditional investments, because whatever they have certain features which our traditional products are not offering. Normally, what are our traditional investments which we are making? They are in FDs, mutual funds, stocks, products. These are the traditional instrument where we have been making it. But now, as our topic is also there, uh, diversification in AIFs are happening. And if you see the categories of AIF, category 1 AIF is high growth startups, innovative products, infrastructure, SMEs. Category 2s are private equity funds, private debt instruments, real estate. In roughly 15% of AIF investments are in real estate, then information technology or enabled products, financials, NBFCs. Uh, and the third categories are basically are complex products, hedging mechanisms, which allows the portfolio to perform under varying market condition with proper allocations, asset allocation, varying allocation they make. The derivative types of products are there, in that are in category this. So you can see how much the growth and gradually the thinking is changing across the people. And I feel as the discussion will happen, lot of clarity will happen, and gradually you might feel wanting to invest in these products. So let me ask Raghunath, who is basically credit head and also managing such funds. He can throw more light on that. If we have to pitch AIF to the investors who might be there here, who has an appetite for high yield returns, what would be your elevator line, or why it makes sense to invest in AIFs?
Thank you so much, sir, for that overview, and hi, everyone. So I think just like what sir mentioned, AIFs has been like a sunrise industry within the overall securities market, right? So just some global context, right? I think in US or other developed markets today, AIF or alternate investments are broadly around 30 to 40% of the typical, whatever, the mutual fund equivalent, right? So they are a very, very large part of the overall securities market, whereas in India, the 5 lakh crore number is still a very, very relatively a small number, but the growth has really picked up, right? And certain pockets of investing has moved entirely into AIF territory. So I think generally there is an acknowledgement world over that the more of the action has been shifting to the private markets, right, compared to the public markets. Private equity, venture capital funds were the toast of the investment portfolios for the last 2 decades. This decade, in fact, private credit has been a very, very strong global growth story, right? And all of this are being done through the AIF route, right? And AIF is a very, very unique vehicle where why has SEBI thought of this, right? So basically, there is a strict guardrail on who can invest in AIFs. So there is a floor on 1 crore being the minimum ticket size. And of course, there is a new, very, very useful mechanism called accreditor investors, where as long as the investor is sophisticated and they can kind of give a declaration that they know what they are taking on, even a smaller amount is okay, right? And this automatically means that people with higher risk appetites, larger portfolios who want to allocate a small but meaningful part of the portfolio for higher returns can come into this vehicle. At the same time, right, the industry is, the whole point of this was to give more flexibility to the manager, right? Mutual funds manage all our portfolios, manage the portfolios of maybe the largest and wealthiest individuals in the country, also manage the portfolios of the most basic common man who's also started investing right today, and the last decade has been that story. So they operate under a very, very strict compliance cycle. They are fairly limited in terms of what they can explore, innovate, and so on. So that is why mutual funds, PMS, and AIF, increasing flexibility in what you can do from an investment strategy point of view. But at the same time, SEBI has been a very, very proactive regulator in terms of setting the ground rules for what AIF managers can do, right? Every aspect of what we do today, starting from when we set out to launch a fund, a PPM document that is thoroughly vetted by SEBI, to what we can do from a fundraise, what we can invest, and there are frequent audits. So in the background, it's fairly regulated to what work we do, but at the same time provides a lot of flexibility, which means that as an investment vehicle, it's most well suited for higher risk taking within the guardrails set by SEBI, and that benefit flows to the investor, right? And I think just some last 5-6 years of performance track record is what has meant that today we go to multiple investors, talk to institutional investors, it's nice. There's a growing allocation to the alternate segments. Today, for example, many large Indian portfolio family offices, etc., have 20% of their allocation to AIFs, right? And this is a category that an investor who can invest in such funds can't miss, because this is where most of the action is. And the third last important point is that by now the performance track record of many of the fund managers has been established, right? Today, as a mutual fund manager, you would know where you want to invest, right? While there are 30, 14 mutual funds, everybody has a great track record, but everybody will have a preference list to say that we know that these guys have invested through these market cycles. And that is already happening with the AIF industry. There is a clear segmentation building up based on performance, and investors are able to say that, okay, if I invest my money here, I am guaranteed of my capital coming back, I am guaranteed of the returns, so why don't I benefit from here? So this, I think, would be the 2-3 important points. Globally, in India, compared to the global market, there's a lot of wings for growth for the industry, and the performance has been really great till date. And the work that SEBI has done to kind of provide the right balance between flexibility and regulation has meant that we are able to deliver those that risk and return.
Yeah. Thank you, Raghunath. And this AIF is one of the fastest growing product. More than 1,500 active schemes are there, and as he has put it also, Raghunath, key checks and controls have been inbuilt by the SEBI, and benchmarking of all AIFs are now compulsory done by the rating agencies. So what it means, benchmarking means the track record of that fund. If any new fund, any company or any AIFs or the investment manager is floating, if you want to see his past record, it is known. So lot of transparencies and other governance standards have been done. Raghunath, you being a part of asset management industries, has been pioneer in this use of technology for fund management, administration and management. How are AIF leveraging these tech tools such as data analytics, AIs to enhance this decision qualities and investor communication? Because you have been very successful in using all these technology, which has helped in this confidence building, as you put it, more than 20% of these family funds, they are family trust and others, they are investing, because now they have a lot of confidence in your capabilities and other things. All these use of technologies must have helped to develop that confidence.
Yeah. No, I think I see this as a continuation of the last session. Many of them were highlighting how technology is playing a larger part in the overall ecosystem, right? In AIFs, of course, I think this is a slightly smaller role, but it's still a very, very growing importance of technology. So typically in what we do, for example, there are two active areas in which we have been trying to develop as much technological integration as possible. One is, of course, on the investor servicing side, which means that, for example, today any investor investing with us, and this is, while I'm talking about me, but mostly across the industry as well, this is what we are observing, is that there is a lot of innovation that is happening on how investor is pitch to investors, capital is received, and also what is visible to the investor in terms of our live view on performance, right? And this has happened across multiple industries. So today, mutual funds have a great tech platform, right? And we are able to see everything that is needed. I mean, within 5 minutes, if you want to invest, you are able to invest, get proof of investment, get a daily NAV. So that is something that the AIF industry is also adopting, right? And on the other side, right, and that's more interesting, on the investment side, right, where we are guys investing in the private markets, right? Not well-discovered companies generally, right? I'm talking about private equity, private credit, and so on. So there's a lot of data out there from government sources, today GST data, bank statements, various other data points. That's all strewn out there in the public domain. But we are able to bring that into a platform, use various tools, and we are able to make decisions pretty quickly these days compared to what we were maybe able to do 4 or 5 years back even, right? Every year, and there are many market intermediaries which have come today. Some of them were there in the previous panels also, who are able to provide those kind of immediate decisioning capabilities to people like us, right? Which is a core strengthening point for the entire AIF industry. So these two angles, technology is an extremely big factor, right? And anybody who's not able to adapt is quickly going to go redundant, right? So to that extent, I think we are also focusing a lot on that. And the AIF industry has been born into already a tech wave, right? So there's no resistance to this change as well. We are building within the overall growth of the industry also. So to that extent, I think tech is a very, very big enabler for our industry going forward as well.
Friends, the structure of AIF can be in form of LLPs, corporate bodies, or trust. And more than 90% of these AIF are in form of trust only. Because of tax benefit, it's a pass through this. So now I will come to Dr. Shikha, who is heading she's managing director. From your experience of the industry, what do you think have been challenges and opportunity for the industry from the perspective of fiduciary agents like trustee and fund administration?
So I'll first go to the opportunities, which is pretty much what also Raghunath said. What happens is in a market, if you have only traditional products and you do not have alternatives, that market is incomplete. So the primary role of alternatives is to complete a market and give it the diversification that every market deserves, especially a market that is of a size of India. And then when we talk about diversification, we get to the point that some of these investments tend to be higher risk. They tend to be also then higher reward. The minute you get into higher risk, higher reward kind of products, the regulation starts to become important. So I think in terms of opportunities, it's a great, it's really great for any market as it's developing to be having alternatives as a sizable composition, because what you're giving an investor is products that the traditional markets are not giving. So for instance, real estate assets, private equity, hedge funds, and what you're really doing repeatedly is removing, is getting to those arbitrage opportunities in asset class after asset class and stepping in where the traditional assets are not able to step in. So that I would say has been the opportunity of the financial markets. You cannot be an India size of the market of India and not have alternatives as a primary player. In terms of challenges, there have been many. Some of them are linked to the higher riskiness and higher reward and less understood dimensions of this market. We used to have something called VCF regulations till a certain point. In about 2012, we moved to the AIF regulations. When we moved to the AIF regulations, we started embarking on a journey of alternatives without realizing that in 5 to 7 years' time, we will reach end of life of a lot of these funds. And the truth is that we had not really thought through how these end of life will operate. That brought us to challenges of saying that, do we have enough information? Are there funds that are breaching their tenors? Are there accidents about to happen. Because in Indian markets, I think one thing that spreads a paranoia is an accident. And I think somewhere there was a panic to say that a lot of funds have started to reach their end of life. Are we sitting on potential accidents where fund managers have raised the funds but have not exited, or they are sitting on investor money? Coupled with this was also somewhere a lack of thought or understanding to say what breach causes what action, what breach requires what kind of action. So we started at the peak of the panic when we just knew that we didn't know enough, we didn't have control of all of the data. We started with, extreme reactions of fit and proper notices, 11B actions, for something as simple as a fund breaching the life with something like 98% investor consent. But I would say it was well founded because what it also spread a message very clearly to the industry was that you've had a certain PPM, you've made a certain promise to the investors, you are a regulated product as far as India is concerned, even though it's a private market. When you come into this whole tunnel of being a regulated product, you better be true to your PPMs. And if you haven't, then you better come back to the regulator, or you better find a solution for your investors. That was what it was. That was the principle. So the principle was well founded. There was confusion because we had not seen enough of AIFs. We didn't know enough. And that led to some amount of confusion, but over a period we've settled. I think the policy is now quite well written to say what kind of breach. We ended up with some, also policies like allowing dissolution period for where people ran end of life breaches and all of that. So overall, I would say, and the second challenge also is in the asset management industry, understanding the importance of information. So unlike a mutual fund industry, which settled over a long period and people were very settled, everything was in public domain, there were daily NAVs and people were very settled to information, this is a private market. Now obviously you cannot equate it with mutual funds. It's a private market and therefore it calls for a different set of information. But when you ask for that information has to be available for the simple reason that some parts of the industry some parts of the ecosystem will need to monitor at an aggregate level who's breaching what. And there also are systems, our policies, even though they were laid down, we didn't know who was following it and who was not following it. It is true that at some point in time we've had a lot of policy confusion, but it is also true that we've seen cases where fund managers have just, the fund is open, money has not been returned, but the fund managers are not traceable. So that's also something that the regulators need to consider. But they also need to consider that at the end of the day it's a private market. It has, the minimum investment size is very high, and therefore what you have is investors who are very aware in their own right. I would say that as an industry we've evolved much more. We are still evolving, we are still discovering. And data, information, tech, all of these would remain key. But it's, in terms of opportunity, it's, the magnitude is just huge. It's just huge, and no amount is enough when it comes to giving our investors a chance at alternatives.
Dr. Shikha, you have exposure to other jurisdictions like Mauritius, Singapore. So what do you think are the key jurisdictional consideration for these global LPs eyeing Indian AIFs?
Sure, thank you. So alternatives in rest of the developed markets is again quite a mature product, because like I said, it completes a market, it gives diversification, and it also then gives those returns to basically completion of market. But the LPs have multiple choices. If they want to invest in India, then the investors can come from multiple jurisdictions. They can come from a Singapore or Mauritius or a GIFT or a DIFC or a ADGM. What we've recently seen is a lot of traffic coming from the GIFT City for Indian funds, because it makes sense. You are onshore, you're pretty much onshore, you're getting a neutral jurisdiction which is dollar denominated offshore. There are tax exemptions for the asset managers, the GST is not there. And therefore, it makes a lot of sense for the vehicles to come from the GIFT City. We are seeing a lot of vehicles coming from there. What we are lacking is a VCC structure. And because we are lacking a VCC structure, we still see a lot of traffic going to Singapore. We also see Mauritius. We see Mauritius for different reasons because Mauritius has really matured as a market as far as the funds jurisdiction is concerned. A lot of people historically have had a lot of structures that have been coming from Mauritius, and therefore that remains. We see DIFC and ADGM largely for funds that are coming with GCC investors, but we see all sorts. Singapore is also increasingly becoming the regional hub as far as financial markets are concerned because of geopolitical reasons. And therefore, a lot of what we saw in Hong Kong, we see moving to Singapore. They have also been very, very timely in terms of the VCC setups being very mature by now. And also because a lot of family offices we see moving to Singapore, ultimately AIFs also come from there. But I think if I have to say which is the jurisdiction that's winning the most as far as India funds are concerned, it's by far GIFT City, because we are seeing lots and lots of both feeder funds and routing funds coming from GIFT City. When we talk to the investors, what are the challenges that we hear, which are the jurisdictional challenges? GIFT City is, of course, the most cost-effective jurisdiction because it's also onshore. It's very easy. Singapore is expensive, even though it has a VCC, which is very economical. Mauritius is less expensive. I think the single most thing that keeps coming to us from the investors is the whole shadow of SEBI getting into GIFT IFSC. And the doubts that we keep hearing are that, even though it's a jurisdiction which is competing with, say, jurisdictions like Singapore, Mauritius, or a BVI, or a Cayman, or a DIFC, there is an overhang of SEBI. Everything is the regulations, the certifications, everything is, and we see that fear a lot to say that would IFSC become another India in terms of its regulatory tightness. And what we see a concern on is a clear differentiation that alternatives is a private market and not a mutual fund.
Raghunath, I would like to continue same. What are your experience of this attracting these global investors in AIFs? And further, what structural enhancements are needed to increase further this cross-border participation?
Yeah, I think Dr. Shikha gave an insight on what is the jurisdictional preference, right? But generally from a commercial attractiveness of the AIF industry in India, right? So, because we day in and day out talk to offshore investors who are interested, over time, right, we have seen certain segments of foreign investors participate very actively in the alternative space, right? But the fundamental requirement is on yield being significantly higher. When India becomes attractive is for returns of upwards of 17-18% INR, which translates to 12-14% dollar, right? Because the hedging cost, etc. And this is a fundamental bottleneck because, of course, India is always compared from a sovereign rating point of view. US is AAA/AA now, but India is a BBB, and the companies are considered sub-investment grade, right? So to that extent, there is always a capital which chases only high yield opportunities, but that has been plenty in India, right? So there has been real estate, there has been venture capital, there has been distressed debt, for example. That's been a segment which has attracted a lot of foreign capital. On the other side, there are some investors, of course, who are not as commercially oriented. So there's been a lot of investments from the global impact community, including the multilateral agencies. So that's been a very, very large active pocket of investors who have invested, regardless of the constraints that I mentioned, right? But what has been conspicuously missing is the middle, right? Take general commercial investors who would invest in mid-deal products, right? So that global investors, they don't find India attractive, especially today when the differential between India and US yields are at their lowest, right? So today, any investor, the first question they ask is, I can just move down one rating in US and achieve the same return. Why should I take so much trouble, right? So to that question, I mean, either India's sovereign ratings have to see an upgrade, which is a long-term story, or there are other innovative solutions. Right? So for example, today there are guarantee-backed structures that one can do, right? Marrying both, basically blended finance, take the impact capital, provide higher, higher returns for the senior investor, and that brings. And we are having these active conversations within our house, and also many of the other market participants are doing this, where there are commercial investors. When I say commercial investors, this could be insurance companies, pension funds in global jurisdictions, who can look at all across the yield spectrum in India. Today, they're operating only in a particular yield segment, right? So this is one key thing that we are seeing, and this is also slowly getting addressed. So many guarantee companies are very active today in India. There are credit enhancement structures that can come in. Today, there is a Cat 3 market that's opening up, which means fund leverage can be taken and provided, higher returns can be provided. Right, and GIFT City, tax efficiencies. A lot of these are getting addressed slowly, but everything has to move in parallel, and India growth journey also has to continue for mainstream commercial capital to come in truckloads into India, right? So that's what I would say is the current scenario from a commercial perspective.
Because US, say, 30-year bond now is above 5%. Their 10-year Fed yield is around 4.6. And though we can gradually feel proud that our spread has reduced, but challenge is there to get the global money, capital inflow. We need those funds because we want to go faster. We want to develop infrastructure. Those are developed countries, so their infrastructure have been developed over a period of time. Now we are aspiring society, as we all say, demographic advantages with us. Mostly we see younger people. Raghunath, what do you see as the next frontier for innovation in AIF strategies?
Okay, just continuing from my previous comment, basically 2-3 things are happening. I think the GIFT jurisdiction and also how funds are getting structured in GIFT is a very interesting development, right? I think today, for example, we have one fund operating out of GIFT City, where we have been able to take in capital very quickly. The hedging strategies are very, very different compared to what we would have normally employed, right? And investors are able to, I mean, from start to finish, we could get the fund launched within 6 months, right? So it's a great outcome for us, right? Number 2, like I mentioned on the fund leverage point, in the sense till now India is very, I mean, this is second level of risk, right? We are saying AIF itself is a slightly high risk product. On top of it, we are saying we will take leverage of the fund, which means it moves to that what is called hedge fund territory, right? But that's a required imperative for the market. If done well and regulated well, that can be a product which can unlock a lot of capital. And we are already seeing some action there. There are already 2-3 case studies of fund leverage being taken in India, and that can significantly move the needle in terms of how much capital can come in. And I think there has also been some tightening and loosening of participation of regulated entities. So only yesterday or day before, there was a regulation from RBI had actually loosened what they had tightened earlier, which is investment by regulated entities into AIFs, right? So that's another key thing that can change how the market will progress from here, right? So multiple angles in which this is happening, but I think the next frontier is mostly to do with jurisdiction, how we take the capital from offshore, and also how we kind of add to the returns based on exactly what one does, right? Just the fund can deliver whatever returns, 12%, 15%, but can that return be enhanced by other strategies, right? So that's where I think a lot of action will happen.
And so far discussion, it must have been slightly clear. These AIFs are basically a private pools of investments, investing in specific different sectors are there, generating phenomenal or high returns. Now I would like to ask Shikha your one last question. What do you think AIF have been able to play the role of catalyst in market development? and whether that AI will become mutual fund kind of story for India someday.
See, I would say we keep going wrong on a comparison with mutual funds. Both are completely different because alternatives play the important role of completing the market. Any market, I would again reiterate, is incomplete if they don't have alternatives. In terms of playing a key development role, let me take a small example of, see the kind of VC money, see the kind of venture capital investments and the private equity investments that Indian businesses have benefited from. A lot of it is structured as AIF. In terms of market development, so on the one side, you will have the private businesses that need that investment before they have hit the target or before they have become ready for a stock market listing. Who funds the businesses till the time they are ready to hit the stock exchange? That whole piece is what the private equity and the VC funds basically complete, and that comes in most of the times through the pools of alternative, because it's all pooled vehicles, privately pooled vehicles. That's one piece of completeness. In terms of the asset classification, so in the developed markets, if I look at the alternatives pool of a developed market, about 70% would be private equity, about 11% would be private credit, and balance 11% would be about your real estate. What is it that we are seeing in India? We are seeing India moving almost in the same trajectory of about 62% being private equity, of about 6% being private credit, and about 32% being real estate. Why? Because India has always been a real estate-driven market. So what is really completely underdeveloped for us is a whole private credit market. And that is the other opportunity that alternatives bring to the market. The whole expansion of private credit, when the banks are not actively lending or banks are able to lend to only a certain pool, there is another pool that needs a private funding. Your alternatives, and especially your private credit funds, step in. That's the other pool. And then you have products like InvITs and REITs. So we are now seeing, say, something like an SM REIT or an SIF. So InvITs, REITs, these become very important vehicles where you have a normal investor investing in something like a toll road, through the alternatives. The other piece where, again, alternatives play a role is something like an NIF, where the government of India will go and set up alternatives and have them do private equity investments into sectors of strategic importance. So digital infrastructure, other pieces where the economy needs funding. These are bigger pools. What is it that NIF brings to the market? It brings you investors like a GIC. It brings the best investors in the world, because there's a government of India backing out there. So you can, and there is an exponentiality that it creates. Every time that government puts in 49, somebody else puts in 51, and there's a huge exponentiality that you create in that whole piece. So that's the other piece. And then the last piece where it really leads to market development is wherever there are arbitrage opportunities, it actually makes the market more efficient. We still do not have the kind of hedge funds that operate globally. But the minute you get to those kind of funds, it will India will become a much, much more efficient. The market becomes much more efficient because there is just no window of arbitrage that these funds will leave anywhere. They will take out every bit of arbitrage opportunity that is sitting in any asset class anywhere in the country. So I would say it's not just what it does to the markets, is absolutely essential, because without this, you have a market which is not complete with only traditional investments.
Initially, when I started this, I said, okay, I will not stretch your patience for lunch. If I have to summarize this AIF, I feel that now AIF have become compelling options especially for HNIs with financial ability or risk tolerance for such sophisticated investment avenues, and diversification from the traditional products have already started. And I feel the name of AIF, basically whether we call it alternate investment funds, or one name I also gave, adventurous investment fund. Now, gradually, it has become advantage, I feel, it should be like that, advantage investment fund for both the borrowers and for investors. And because of this reasons only, it's the fastest growing product. And one more thing I would like to say. Recently, in month of January, I attended one training session for AI. It was an eye-opener. From the both sides, now even the investors are wanting to invest. Now young entrepreneurs are wanting to float this AIF. That training was for how to start one own AIF. So around 150 people were there from 40 different places pan-India. So much interest is there. They want to start their own ventures, startups, high growth areas. So that thinking is changing very fast. So I feel the topic is valid, and the future of diversification in changing Indian, as our capital market is evolving very fast, is happening very fast, and like any developed countries, it will be a game changer in times to come. Thank you to all.
Thank you. Thank you, everyone.